Are you bouncing around, or are you only in the money one? Get to bounce around a little bit. Meet a few of the vendors out there. So, is this working now? Oh, there we go. So, my name is Randy Tate, and I am the CEO of iFlip. iFlip is an acronym, and I know there's a clicker up here somewhere. I'm thinking. Boom. It stands for the Financial Learning Information Platform. And what I'm going to talk to you guys about today, a lot of this stuff you'll probably already recognize, and you'll know. You'll know the problems are the problems I'm going to tell you about. What I'm going to show you, though, is a very unique way to handle it and to change the way the world is starting to invest. Now, let's see if this goes forward. So our company, when we put this company together, we were thinking about how do we create something that's, one, scalable, and two, can actually help the masses. And our first year, back in 2017, we literally spent a half a day, all 8 of us, I think there were 8 of us at the time, wordsmithing why we were doing this. Because if you've attended any things on culture, or you know anything about company workings, you'll understand that if the company, the folks involved aren't bought into what you're doing, it ain't gonna work. It won't work. So we spent a lot of time on that. And we came up with a very specific purpose statement, and that's to empower. That's the key word in there, to empower everyone, not super rich, filthy, wealthy people, and not just putting everything towards the folks that are maybe a little more downtrodden or less fortunate. We want everyone, not just America. We want everyone to be able to preserve, protect, and grow their wealth. How do you do that? You just hear the insurance people talking about, kids don't want to do this, and they want to do the opposite of your parents. They all want to play video games. They want to do all kinds of other stuff. So how do you entice those guys? It's a very daunting task, but that was what we set out to do. That's what we set out to do. And we did it with significant intention. And like I said, my name is Randy Tate. This is my 3rd company that I've started. The 2 successful exits previous. This will be 3rd and final. And my background is in education. My master's degree is in education. I'll teach you a little bit about my business partner in a little bit. He's the one that really knows the money stuff. But I know how to grow companies, and that's what we're doing. And so, what are those problems I was talking about? Well, there's 2 groups. There's the average investor. How many of you consider yourself an investor? You invest money. Raise your hand. If you invest money, okay, perfect. You're in the right conference then. Hey, you never know. So, all of you invest money some way, somehow. So the average person has been taught that a 9% return in the markets is just acceptable. That's what it is, and it comes with no risk. Many people aren't even old enough to remember the last time it was hard to invest in the markets. It's happening right now. And they've accepted it as fact. Now what this is Wall Street passing all the risk of investing over to Main Street. That's what it does. Moves it all over to Main Street. Lets Main Street absorb the risk. Wall Street will then reap the reward. We also accept the fact that if we go to an advisor, that advisor is going to charge us fees, and that's just what they are. And they're very complicated, so I can't figure them out. So if I don't know what the fees are, I just pay them. So that's a problem. The new generation of investors, they just go get Robinhood. Let's just download the app. It's free. I can buy and sell on my own, get the meme stocks. I'm dominating the world. And then they lose their tails. They don't know what to buy. And so we just go get crypto. Same thing. What do I buy? How do I even get this thing set up? How does many older folks that I speak with, they don't know what a wallet is. How do I go to what do you mean an exchange? Coinbase? What's that? What's this crypto key thing? So they don't know, and they don't want to learn. These are the problems for the average investor. The sophisticated investor has a little bit more issues. If they're trading themselves, so if maybe you're smarter than the average, so you're going to do it yourself. You're pretty smart at it. So you run into a few issues, though. You run into these issues right here. Where do I get my data? How much does it cost? How much time does it take to manage your own money? Anybody in here manage all their own stuff? Yeah, 5 minutes a day? 10 minutes a day? Yeah, it takes time, doesn't it? It takes energy, and you got to get the right data. And trading for income versus investing for a financial freedom style day. Those are two different animals, okay? On the crypto side, just the ability to identify anomalies. How do you do it? What kind of data science are you pulling, and where are you getting it from? You know, multiple platform inconvenience. Well, the Bitcoin's one price on Coinbase, it's another one on Binance. Which one do I buy? Do I need both? And then fees. Fees are significant in crypto, and they're all over the board. They're all over the board. Any crypto investors in here? A few of you? Couple? Some? Okay. Yeah, those fees can get you. And like I said earlier, the pricing between the exchanges just often is not the same, right? So these are the problems we wanted to solve. Now, the last company that I owned was an executive coaching company, executive training. We helped with marketing, lots of stuff like that for big companies and small ones as well. Pretty much the world of marketing boils down to three things. You're either telling the world that you're better, you're telling the world that you're less expensive, or you're telling the world that you're easier to use. That's it. That's the magic of marketing. If you want to be disruptive, though, and really make noise, you have to do all three. You think of little companies like Netflix. They're better. They're easier. They're less expensive. Who wants to go to Blockbuster? I think there's only one left. Same thing with Uber. That's the kind of mentality we started with. We started from that perspective. We wanted to be better from the get-go. We want to put a product out that allows you, the average individual, to participate in the market, to be empowered to beat the market. Number one. Number two, we wanted to be much less expensive than any advisor, any professional money manager, much less expensive. And number three, we wanted to be as easy to use as Robinhood. Point, click, touch it, go, done for you. Make sense? Sound pretty cool? Does the idea sound cool? I can't really see this. It's really bright. So the idea is, I have this conversation with people all the time. If I can show you a way that in less than 15, 20 minutes of your time, your portfolio can go up in performance while absorbing less risk, be easier to manage, and cost you less money, would you be interested? That's the conversation. And that's what we talk about, because that is really what we do. So Wall Street's taught us that we want to, stay the course, buy and hold. Who's heard that before? Can't time the market, right? Can't time the market, so buy, hold, be here for the long term. It's not true. It's a myth. You can time the market. You absolutely can. So that is one. Or maybe you've got a lot of money and you've got these private managers that are taking care of you. In the United States, the average portfolio that's professionally managed, that's under $1 million, is paying on average fees of 6%. Now you don't see that anywhere. A lot of those are on the backside. They're coming out the back end. Their funds are charging the fees. The money manager, that your advisor, puts your thing is charging a fee. All right? Or we have to try and do it ourselves. Really, that's what it comes down to. We have to try and do it ourselves. So we built an AI-driven, automated trading machine. It's not just a bot, and it's not an algorithm. I'm going to talk to you a little bit about that in a minute. So who would you guys think the target audience would be for an app that does it for you, that outperforms the market with less risk and is less expensive? Who? Say it. Somebody say something. Who's that for?
Common retail investor.
Yep, absolutely. Is there a few of those out there?
Millions of them.
Yes, millions of them, yes. So the average Joe, that's who we're talking about. Now, I'm going to give you an example as to why, and I'm going to point to you some real statistics and numbers. Probably that's what you wanted to see anyways. So institutions, advisors, the professional world states that the cost of missing the market's best days is so expensive that if you miss them, you're screwed. So you want to make sure you buy, you hold, you leave your money in so that you can capture those days, right? Back one. I'm going to show it to you in a second. So most of you have seen a chart like this. You know that a 50% drawdown, what do you have to do in performance to get back to zero? You have to do 100%. People scratch their head when I say that a lot. What do you mean I got to do 100% return? I only lost 50%. Well, if you got 10 and you lose 5, you're left with 5. What's it going to take to get back to 10? 100%. You need 5. So that's the mindset of it. And when you think about the time it takes to recover, I think this has one of these little green guys on there. No. Doesn't work. So the time it takes to recover. So if you lose 50%, the average time to recover in the traditional market is 11 years. 11 years. So if you don't have 11 years left to get back to zero, you got to try something else. You got to do something different. So we want to make sure we're not absorbing those big losses. How many of you think that a correction's coming? Oh, good. Everybody, you're listening. Yeah, we all kind of think that a correction is imminent, right? It's going to be a big one. We have a little different stance on this. We don't say it's important to hit the best days of the market. We don't. It's okay if you don't. So let's look at the math. So if you bought and held for the last basically 20 years or so, $1 million just in the S&P 500, and you just held it, it'd be worth about $5 million now, a year or so ago. If you miss those 10 best days, here's their argument. That $5 million is now just a little over 2. If you just missed 10 days, just the 10 best days of the market, you were in it the entire rest of the time. However, if you also missed the 10 worst days, you missed the 10 best, but you also missed the 10 worst, that $5 million goes to 10. So is it more important to try and capture the top or to avoid the bottom? Which one, according to this math, which one's more important? Missing the bottom. You don't want to ride that thing down. You want to stay out of the valleys. It's a big deal. Does this make sense? You guys following? So I'll put it on a chart, make it easier for you. So you got 3 charts here. The one in the middle, buy and hold. S&P 500. Just buy it, hold it. The one on the bottom, miss the 10 best days. You tried to do it yourself, you just missed those 10 days. You were in the rest of the time for 20 years. The one on top, you also missed the 10 worst days. So it's all about risk management. How do you manage the risk? How does the risk get managed? And I'm going to show you, one more thing, how we do it. We do it with AI. A lot of people say, lots of people use AI these days. No, they don't. They don't. An algorithm is not AI. An algorithm is simply a set of rules programmed into a computer that the computer executes on. Programmed by who? A person. A person programmed it. Algorithms are good. They're important. We like them. They're our friends. But they decay. They break down. And over time, they all fail. AI is a little bit different. AI is also an algorithm. However, it's an algorithm that doesn't decay. Why? Because it can change its own rules. I'm trying to make this super simple for those of you that don't know the world of AI. What do you mean, Randy? It can change its own rules. Well, an algorithm, like I said, it decays, it starts to break down. In order for that algorithm to change, a human has to go in and reprogram it, put new data in. AI receives its data consistently. The data just comes in, and the data feeds the algorithm that is the AI, such that the AI can then change its own rules. So maybe it's buy Apple today or sell Apple tomorrow, or who knows. Whatever the math says. It is mathematics. And it is important to understand that the AI is very, very different than an algorithm. Right? This is true automation and execution. What you want to avoid is that human element of having an opinion. You know, people ask that all the time. Are you fundamentals, technical? Well, it's all technical because it's all data and it's all math, because we don't want people to have an opinion. An opinion's like, oof, that'll get you eventually. All right? And now I'm going to introduce real quick, and then he'll be part of the Q&A with me, our co-founder and our CIO, Kelly Korshak. So Kelly, wave your hand. Some of you guys might have seen him over at our booth. He's right there. He's sitting at the table with you guys. They're all looking behind you. So Kelly's the brains behind this AI. 100% the brains behind it, not me. Pretty smart dude, went to Stanford, went to Stanford's physics program when he was 16, graduated the University of Chicago with, statistics, mathematics, finance, went on to Wall Street to be a quant on Wall Street. Managed money for little places like Deutsche Bank, where he ran the risk desk, which means, if you don't know what that means, it means he had about $6 billion of the bank's private money that he was managing the risk of. Risk manager. Kind of get the theme where our software comes from. Now, when you throw all of that together, everything we're talking about, AI, trading the markets, whether it's an ETF or individual stocks, now we've added crypto to the mix. Kelly's become a very big fan of crypto in the last couple of years and started mapping crypto, over 18 months ago. We're literally just going live with it probably tomorrow is the plan. You never know in software, coders, those things just don't always go as planned. But the idea is that we go live with it tomorrow. So how have we done? Everybody asks that question. Everybody always asks one simple question. So how did it perform? And then I've been coached to tell them that's not the right question. The question is, how did it perform relative to the risk took to get the performance? Because if the best performance in the world is right out there, little spinny wheel, they roll the ball around it, it's 35-1. That's how well it performs. So what risk did you take, though, to get that performance is what matters. And we'll talk a little bit more about that. So let's start with the very basic. Simple chart, S&P. The S&P 500 is our benchmark. That's what we benchmark everything to. If you look at the blue line, that's the S&P. If you look at the orange line, that's the orange line trading the S&P. This is fundamental. This is a foundation. So you say, well, what happened here? Well, you can see there's a couple of spots. It doesn't have this little green thing. If you look right there in 2018, there was the first dip. We skipped it. The AI was out at the end of October to skip the dip that was the big day in December. I think it was Christmas Eve, actually. And look at COVID. We were down during COVID just like everybody else, but we were down 3%. So as you can figure, over time, as you move through it, and every time there's a correction or a downturn or something not 100% correct, and you're out and you miss it like right now, we've been 85 to 90% cash now for 60 days, sold a bunch, almost everything else today. I think we're only in one smartfolio right now of all of them. Everything else is in cash. Would you rather have been in cash yesterday, or would you rather have been in the market? Some of you that trade are smiling. Means you were probably in. Now, when we talk about the combination of, I forgot, I was going to show you this. This is what our dashboard looks like. I'm not going to spend any time talking about it. We've got it set up out here for you guys to come look at it. I can walk you through it and show you what it looks like. But we've built a solution. We set out to solve the problems to be better, to be less expensive, and to be easier to use. Along with that, we have much less risk. So we have all this automated protection, all these things. You can trade all these other things. And everybody always asks, well, how many basis points do you charge? Get that question all the time as well. Well, we don't charge any. Well, how do you get paid? Simple. Simple. We get paid on a monthly subscription. We're a SaaS company. For $5 a month, you can trade up to $10,000 on the AI. If you want to trade for free, You can, you just got to do it manually. You don't get to use the AI. And we have people that do that too. All the way up to $150 a month. And we have people on our platform with over $1 million, and their total management fees are $150 a month. Pay for the whole year, you get 2 months free, even cheaper. So we're way less expensive and way more sophisticated than anything else that's out there. And so now I'm gonna finish up with a couple of charts here for you that will show you some performance and leave a few minutes for some Q&A. Particularly, you guys will probably want to ask Kelly a bunch of questions. If you want to schedule a demo, just come out there right now. I'll put this number back up there, but we're in the little, I don't know what you call that over there, where we eat and all the little vendors are. We got a booth set up out there. We'll gladly give you a, oh man, where'd it go? There it is. That's what I wanted to show. Yeah. So this is a little blurry. Oh, where'd it go? All right. But what this is, so just so you guys can get a hint of what's coming in the crypto space, we are blending smartfolios. What does that mean? Well, smartfolio means that AI is doing the trading. But we have set it up so that in this particular one, you've got the Spider ETF, you got Microsoft, you got Bitcoin, and you got Ethereum. All in one spot. No wallet, no key, no exchange. Just set it up, put how much money you want to put in there, and hit go. And off it goes for you. And as we've been mapping it, again, as the drops occur, the AI is creating separation from the buy and hold. So how many of you think it would be a good idea to be able to get the performance of crypto with a nice, easy, smooth ride, as if you owned I don't know, a bond, something like that? Who likes that idea? No? Oh, okay, a couple of you, you're still paying attention, yeah. So I'm gonna go back real quickly here. I'm gonna leave this slide up in case you guys want to schedule a time to have a private demo with it. But more importantly, I wanna see if you guys have any questions. That should have prompted a few questions. Yes, sir.
My question for you is that the key part of your sort of the mechanics behind it seems to be basically you talked about the machine learning algorithm or AI, right, which basically digests the data and produce basically recommendations, right? I had two questions for you. First question was by basically how is the AI set up in order to deal with situations which have never happened before? For example, we are in an environment which we haven't really seen in the past, which is very loose monetary policy, high inflation, stocks basically overvalued. There isn't really data exactly of this environment available anyway for the AI to create sort of accurate forecasts in what will happen going forward, right? So would love to understand basically how do you get the confidence in the AI when it has never encountered these situations in the data from the past? That's one question. The second question is you talked about crypto, you talked about equity. One of the biggest problems for retail investors is also there are no good fixed income solutions out there. Most of the fixed income solutions are really for portfolios of at least $1 million plus. So would love to hear if iFlip has a thought in terms of how they're going to bring fixed income as part of basically the basket of portfolio that you have to offer.
Got it. And I'm going to defer that right to Kelly, as he knew I would.
That first question was, I'll answer first. And that's actually a very good question about how information that we would think we have never seen before can be read in by an AI algorithm to be able to discern or be able to predict what may happen going forward. Well, I have two answers. And by the way, forgive my voice, everybody, because I had laryngitis. I'm trying to come back and be able to talk succinctly. Well, first of all, there was a time before, 40 years ago, 42 years ago, when I started on Wall Street. I worked for a company called Solomon Brothers. And at that time, I came in after I got out of school in 1981. This is exactly what was going on. From the previous years in the 70s, we had hyperinflation caused by oil problems, all the way from the 74 when we had the oil what we thought was a huge oil shortage. We had wage price freezes that Nixon put in charge during the early 70s before he had to leave office. So inflation was something that built up during the 70s, and it was really understood deeply when interest rates rose in the late 70s and early 80s. When I came in and started, the data was already there that inflation was running hot at around 10%, right around where it is now. And also interest rates at that time had actually started to come down from 20% on a T-bill and 10, 12% on a long bond, like a 30-year treasury. So we do actually have data from something like this before, albeit it's not as tuned as the data we can collect today, because today data is everywhere. It's been collected for years. It's been perfected. It's been cleaned. It's very available. But back then, the data was also there. So we do have, for example, information of where the treasury prices were at that time and where Fed funds were or a discount rate was, things like that. We also knew the price of oil back then. So we do have the data. And then, but
Quite a few noticeable differences between 70 and right now.
Yeah.
Not exactly the same scenarios. There are few meaningful differences between the 70s and today's scenario.
We can always say there's differences, but the main point about the data that we have today is inflation is high. We have high prices of oil, and those are two probably the most important factors in being able to measure something to say what could happen in the future. So we all understand if inflation lasts for a long time, that is going to take a toll on the markets. Housing markets, all kinds of markets will take their toll. So we could see, for example, a treasury bond right now that may yield a 30-year treasury could be around 5% on a mortgage, 4.6 or so on the 30-year. We could see these things double literally by the end of the year, because when these things get out of control, they get out of control. But
Right.
a more important factor is, what is AI exactly? Because we hear the term all the time. I hear it used, frankly, well and way too often. AI, everybody, is really a set of algorithms. You can go to the internet and download. There's about 11 AI algorithms. They have all kinds of names. Some of the names are called Bayesian. They're called random forest. They're called linear regression. They're called polynomial regressions. They're things that we've all can see, and we can all get them from the public domain, for example, in Python, and download them to our computers. Once we have them, we don't really know what to do with them, because they're complex. They're trying to do something internally. What they're trying to do is predict something. What is the most important thing to predict if we're in the investment space? It's price. If we can predict price, that's clearly the most important thing that can help us guide how to invest or protect ourselves on a go-forward basis. So when we set up the AI at our company, we do take a lot of data. We have information from the S&P 500 and bonds, treasury bonds, 5-year notes, things like this, the discount rate, Fed funds rate, that go back 70 years or more. So we do have data. Now, again, I wouldn't disagree that there are certain there's always going to be differences in every environment from one year to the next, from what might have happened before 5 years ago, 40 years ago. Nobody would argue that. But what AI is something that eats data and creates predictivity. In other words, we're trying to find how to predict the movement up or down of something. What is going to happen next? In our case, we're trying to predict price. So what we do is we feed the data into our AI algorithms. What data do we feed? Well, we feed the price of the underlying security. Let's take a look at the S&P 500 or a price of a treasury bond. Those are two important things. We invest in a fixed income product like a bond. If I know the price, I know the rate. And if I know the price of the S&P and I can predict it, I might be able to know, hey, maybe in the future the S&P will be lower or higher. We feed that in. But they're correlated, right? There are correlations that are sometimes better and worse between, for example, bonds and stocks, or different stocks amongst each other, Fed funds against stocks, discount rates, if you want to say that, credit card debt. Credit card debt, when there's a lot of credit card debt, generally that means interest rates are generally lower because people don't want to borrow and ramp up their credit cards. So that might have an impact on predictability. So we feed these things into our AI algorithms. Now, one I use two. I use a Bayesian one. Why? Bayesian is something that is just measuring statistics. It's creating huge frequency tables to say, as if this happens with a discount rate, how does that affect the price of the S&P 500? Or the same thing with credit card data. What happens, and what an AI algorithm, and a Bayesian one in particular does, it spits out one thing. It says, this has an impact on predicting price over this amount of time more often than something else. And what we see at the end of it is, frankly, thousands of different curves that were created to say, how would they have done if I used that input to be able to measure and predict price? At the end of the day, what we found and what we use is a mixture of fundamental data and technical data, which is just prices of a bond and things like that. And we put that all together, and we are able to predict at some level of certainty. And the way you do that is, what level? 67%, 95%. To those who are familiar, that is just the ratios of standard deviations on a normal curve. And with that, we have the ability, we think, to be able to help us guide us in and out of the market strategically with no emotion, no hands on, to determine where the price may be in, say, 30, 45, 60 days from now. We're not trying to predict a year from now. We care about the short run. So the answer to the first question is that, yes, the data does exist. Yes, things are different, but it is still valid to use the data that we have, because the same data was actually usable 42 years ago, because I have ran that data against those things, especially now because it's so evident. Something is going on in our economy. We all see it. We all feel it. I'm not here to say the market's going down, but we all sense that there's a probability that that's more likely today than it might have been a year ago. And so now we have to figure out, what is it tomorrow? What is it the next day? And that's what our software does. You invest in it, it guides the decision-making process like somebody that has been around the market with a lot of experience for many years. At the end of the day, it's an experienced person is your best advisor, and or a computer that is using the experience of data to try to do the same thing, except a computer is faster and cheaper. So that's the first question.
That's when we're over time. So if any of you, sorry, we only got to one question, but if
it was a good question.
It was a good question. If you guys have some questions, just pop over to our little booth and grab us. We'll happy answer any questions you guys have, and walk you through whatever you need to know. And thank you guys for having us. We're happy to be here, and thanks, guys.
Thank you.